Hello all, good evening. Thank you, Terence and John, for inviting me to this webinar. My name is Jimmy. It is very encouraging to see all in this webinar on a Friday night, and thank you for joining us. I wish all is good during this circuit breaker. So since the beginning of this pandemic, we have heard people who lost their income and struggling with basic necessity in life, So over here, I just want to say that I'm thankful to be here to be able to share my experience and knowledge with everyone in this webinar. I believe through event like this, we can actually learn better and faster in the group. All right. So without further ado, I'll just share my screen over here. Okay, so the topic I have for everyone tonight is portfolio management. All right. So a little bit of myself. I was a business consultant specialized in international trades. I was an adjunct lecturer at Nanyang Polytechnic. I have investment experience of more than 15 years, currently managing my family wealth. I'm also a wealth management coach, financial gym co-founder and trainer, and financial gym Malaysia trainer as well. So that's a brief introduction about myself. Before I go on, I have to put my disclaimer over here, is that the full content of this program is for educational purpose only and should not be used as an investment recommendations. We are not responsible for all investment activities conducted by participants and cannot be held liable for any investment loss. So if you have any doubt in terms of your investment decision, please consult your professional financial advisor. All right, so good. This is myself 17 years ago. That's me. This is probably the kind of expression that I have when I made successful, profitable trade, right? So when I first started investing, I do not have a system. So I just bought and sold shares at random. When the share price goes up, I'm happy. If it fails, I feel sad. Of course, I will swear that I will not touch the stock market again. But then again, I come back and this whole cycle repeat and repeat. So on the hindsight, I was actually inclined more towards speculating than investing. So the money I make from trading shares did not actually serve me a purpose. Now, I'm saying this on the hindsight, it does not serve me on a purpose. I just spend it on things that a youngster would do at that time, movies, latest gadgets, partying, And yet the money I lose actually comes from my paycheck, right? So long story short, I was still poor like hell during my first few years of speculating in the stock market. And at the age of about 30 years old, right, I have less than $10,000 in the bank account, full of debts, house loan, car loans, whatever loans that you have it, So at that point of time, I sort of like woke up and feel that something is not right. And I thought, I really have to be serious in terms of my finance. So I did a lot of things, but to make it short, I actually start to learn from the smartest people I can find around me at that time. And they taught me the first lesson, which is the portfolio management. So since then, things take a drastic change by following a simple process, right? And my investments start to show a positive returns. First, it was just a few $100s per year. And then slowly it came close to thousands, then 10,000s, and then eventually multiples of 10,000s, all right? There's no magic about this. And I'm actually using a very, very simple and boring technique, right? It's called the power of compounding. Now, for those who doesn't know what is this, is actually a very simple thing. So if I have 1 + 1 = 2, and then 2 times 2 equals to 4, 4 times 2 equals to 8, and then, sorry, 4 plus 4 equals to 8, and then 8 times 2 equals 16, and then you just sort of like multiply. So that's basically part of the compounding. And if you compound an interest over a long period of time, the kind of the gain is enormous. And one of the ways to look at it is actually your own CPF account, right? So every year, and when you go up there and open up your CPF account statement and you look at the kind of interest that actually credited into your ordinary account or your special account, that is actually the power of compounding. So anyway, so I see a lot of people see investing as a buy low, sell high. All right. So let me define this correctly. Buy low, sell high is not investing. It is trading. All right. So if today I buy SIA at $3.76, I know that a lot of people won't buy SIA. I don't buy SIA as well. All right. But just take it as an example, and sell it at $9.76 with a $6 profit. The question here is that, then what? You make a $6 profit, and what are you going to do with it, right? But again, if SIA is one of the stock in the basket, in the stock basket, and that basket is built for a special purpose, for example, a retirement fund, or for a very specific things like maybe investing in a property, or something that actually can generate an income. In other words, that basket is built for a certain goal, all right? Then this investment has a completely different meaning, all right? So for example, I can actually build this basket of stocks with intention to live with a passive income of $5,000 a month for household expenses. And I define a date for it is by the age of 55, right? So this $6 that we talk about, by selling an SIA shares of $6, it becomes very meaningful because it actually serves a purpose of why you need that $6, and it becomes part of your goal. So the 3 simple steps of constructing a portfolio, and we just talked about it. The first one is to define your goal. Now, then the rest is basically technical, right? The next step after the goal is what we call the allocations. Now, once we have really defined the goal and we want to look at allocations, and it becomes a lot easy because why? Let's say if you want to look at a $5,000 income or passive income or whatever you want to call it, all right, per month, that means what you need is $60,000 a year, right? So there will be a 2 ways to look at it, right? If you work backward, either you have a capital of $1 million that give you 6% return, that will give you $60,000, or a $500,000 capital with 12% return, or $250,000 at 24% return. All right. Then the second thing in the allocation portion is the runway. What do I mean by runway? Is that how long does it take for you to arrive at 1 million or 500K or 250? So this is basically the runway that you have to look at it. Then once we define these numbers, we can start to look at the things that this fundamental scorecard group is talking about, stock pick. So just now, Xue Hui has talked about how to actually pick stocks, pick good companies, by looking at their finance, by looking at their valuation. Yes, all these falls in the category of allocations. Why? Because that's where you want to put everything in the right place and under one basket. So over here, just for example, you may want to pick a gaming company, or you want to pick FANG stocks, or you want to pick a BAT stocks that give you a double-digit growth per year. That will allow you to compound it over a period of time to reach your financial goal as what you define in the first steps. Then, once you do that, you have your allocations been built up, you basically will have a portfolio that's divided into percentage, right? 10% of this, 15% of that, and then that consists of a portfolio. Now, the last part is the rebalancing. Now, this is the one that most people neglect, right? So even if you pick the right stock, do the right allocation, you will still need to rebalance it once in a while. That means what? That means you got to sell some stocks that has gone up and you got to buy some stock backs that was being beaten down. Now, I cannot stress how important is this in terms of, sorry, I should just go to these slides about portfolio management. But anyway, I cannot stress the importance of this rebalancing. So let me just show you an example of what you mean by rebalancing of this portfolio. I will just go into a spreadsheet that I just created earlier on. I hope it's not too small for you guys to read on the screen, but I just try to put up the size. Now, I bankroll all these names is because these are the real stocks. And because this is an education purpose, so I do not want to put up those stocks name. But I will just name it as ETF A, B, C, and D. Assuming that we have these 4 ETF that we buy at the initial cost, and this is the number of units that we have purchased with a total portfolio of $10,000 and each allocations of 25% each. Now, each of these ETF or stocks, it will have a target growth, and all these informations can actually be found through various platforms. So ETF A would have a 3% growth target, 6% growth target, and C would have 13% growth target and 20% growth target for ETF D. So all these will be weighted and compute as a portfolio of 11% return. Now that is the day one when you start putting money into this portfolio. Total value is $10,000 with a target, growth target of 11% return per year. So what will happen after 6 months? Now, assuming after 6 months, this is what happened. The price of ETF A actually gone up to 2.9. B went up to 5.6. C went up to 448, but D actually came down. My total portfolio will be 11,387.6. So it's a gain, it's a positive gain. The percentage of the portfolio at this point of time, as you can see, is no longer equal. So now B is at 32%, D is actually at 19%. When I start to compute this weightage again, you'll be surprised that the gain going forward dropped from 11 to 9.61. So you can see that I did not do anything, right? I just sort of like let the time pass by, looking at the stocks, picking at the right ETF, making sure that everything is done correctly. My total portfolio has increased, but my target growth actually decreased. Now, this is something that we do not want to have. You know why? Because remember, the first step that we need to do in a portfolio is that we are managing the goal. Then the goal was, say, 11%. And we just want to make sure that this goal that we want to achieve will try to hit the target, the 11% target. So at this point of time, we would need to do something. That is, we will keep, because this is 25%, right? So we will keep this 25% of ETF A. We will sell some of the ETF B, which is from 641 units down to 510 units, make it 25. This is sitting more or less like 25%, okay? So we keep it there. And for this, we will need to add on positions, all right? Add on positions to increase it into the from 19% to 25%. All right. So, so we are increasing from 26 unit to 34 unit, my mistake, right? So that in this case, I start to balance it up, all right, balance it up. My total portfolio becomes 11,334, still positive. But now by doing that, I actually adjusted my weighted gain, all right, weighted gain to 10.41%. Taking the difference between these two, I actually cash out $53.60, which is just nice for me for 1 week of Taipeng. So not bad. So by doing this balancing thing, I continue to add on the shares that's beaten down and getting some cash out, at the same time gaining from the target growth from 9.61 to 10.41. So this is the balancing process that we need to do. And it's actually part of the three framework that I was mentioning earlier. So to repeat that again, 3 steps to portfolio management. First thing, define goal. Second is to have your allocations done correctly. And then third is that once you are into it, you need to rebalance it once in a while, right? So that's basically the most basic simple of a portfolio management. Right, so my name at the Financial Scorecard Telegram group is Jimmy _ SGSG. You can actually look for me there. I have a Facebook page where I contribute articles on REITs, ETF, and local stocks. And this QR code will actually goes into my page. And I'm running a financial gym course. It is a 1-year program to enhance your financial health. And of course, if you want to know more about it, you can actually scan this QR code, and that will lead you to what I am doing. This is my avatar in my Telegram group. So the Mona Lisa with a short hair, that's basically myself. So with that, I would end my presentation tonight. I hope you all learned something out of this. If you have any question, please ask. And obviously, I will leave it to John to compile those questions and get back to us. Right, thank you, everyone.